If you want to make money in US stocks, this video is for you. And I want you to listen carefully because this is not hype. This is not a get-rich-quick promise. And this is not fake motivation. This is real knowledge used by smart investors every single day in the world's strongest stock market, the US stock market. Most people believe stock market success is about luck, timing, or insider tips. But the truth is very different. People lose money not because the US market is risky, but because they invest without understanding how money is actually made. In this video, you will learn how disciplined investors build long-term wealth in US stocks, even if they start small, even if they are beginners, and even if they are investing from outside the United States. The US stock market is home to the most powerful companies on the planet, like Apple, Microsoft, Amazon, Google, Nvidia, and Tesla. Companies that generate revenue globally and grow year after year. When you invest in US stocks, you are not gambling. You are owning a small part of real businesses that solve real problems for billions of people. Many beginners think US stocks are only for rich people, but that is no longer true. Today, anyone can start with a small amount because the market allows fractional investing, meaning you can own part of a company without buying a full expensive share. Smart investing is not about how much money you start with. It is about how consistently and intelligently you invest over time. Money is made in US stocks in only three real ways: capital appreciation, dividends, and compounding. Capital appreciation means buying shares of strong companies and allowing their value to grow as the business grows. Dividends mean earning regular income when companies share profits with shareholders. Compounding means reinvesting your profits year after year so your money starts working for you instead of you working for money. The biggest mistake beginners make is chasing fast profits instead of focusing on strong fundamentals. They buy stocks because of noise, social media hype, or fear of missing out, and they sell during fear, panic, and temporary market drops. Professional investors do the opposite. They buy high-quality businesses when prices are reasonable and they hold them with patience. The US stock market rewards patience more than intelligence. Another important thing to understand is that market drops are not your enemy. They are your opportunity. When prices fall, strong companies do not suddenly become bad companies. They simply become cheaper. Smart investors see market corrections as discounts, not disasters. Risk in the stock market does not come from volatility, it comes from ignorance. When you invest without understanding a company, you feel fear when prices move. When you understand the business, short-term price movements no longer control your emotions. Successful investing is more about psychology than prediction. You do not need to predict the future. You need a process you can follow consistently. That process starts with choosing strong companies, staying invested long-term, managing risk properly, and avoiding emotional decisions. US stocks reward those who think long-term, stay disciplined, and respect the power of time. In the next part of this video, you will learn exactly how to choose the right US stocks, how much risk is actually healthy, and how beginners can create a simple system that works even during bad markets. Now that you understand the mindset, let's dive into the practical steps smart investors follow to grow wealth in US stocks. First, you need to identify strong companies. These are businesses with consistent revenue growth, competitive advantages, and leadership in their industries. Look for companies that solve real problems, have loyal customers, and a clear path to future growth. It is not about trendy stocks or social media favorites. It's about quality, stability, and long-term potential. Next is risk management. Risk is inevitable, but it can be controlled. Never put all your money in one stock or sector. Diversification is key. Spreading your investments across multiple strong companies reduces risk while giving your portfolio a chance to grow steadily. Beginners often underestimate this, but even small amounts invested wisely over time can build substantial wealth. A consistent investment plan is the next crucial step. You don't need to time the market perfectly. Instead, set up a routine, monthly or quarterly investing, and stick to it. This strategy, often called dollar cost averaging, ensures you buy more shares when prices are low and fewer when prices are high, reducing the impact of market volatility over time. Dividends and compounding are powerful allies. Reinvest every dividend you receive. Compounding turns even modest investments into significant sums over years. The earlier you start, the stronger the effect. This is why long-term thinking is so critical. Time, combined with patience, becomes your most valuable asset. Finally, focus on learning and improving your process rather than chasing shortcuts. Read financial statements, follow company earnings, understand the industry trends, and most importantly, manage your emotions. Fear and greed are the biggest enemies of investors. The US stock market does not punish knowledge. It punishes impulsive decisions. By following these steps, even beginners can create a system that works through market ups and downs. In the next section, we'll break down exactly how to select the right US stocks, how to calculate reasonable risk, and how to build a simple, repeatable system that turns small, disciplined investments into long-term wealth. Choosing the right US stock starts with understanding the business behind the stock. Look for companies with strong revenue growth, consistent profits, and a clear competitive advantage that allows them to dominate their industry. Analyze the management team, their track record, and how they reinvest profits into growth. Avoid companies that rely on hype or speculative trends. Next, assess the company's financial health. Check the balance sheet for manageable debt levels, strong cash flow, and sustainable profit margins. Companies with strong fundamentals are more likely to survive market downturns and continue growing over time. Another critical factor is valuation. Even the best company can be a poor investment if bought at too high a price. Use basic metrics like price-to-earnings ratio, price-to-sales ratio, and compare them with industry averages to see if the stock is reasonably priced. Remember, patience is key. Buying a great company at a fair price and holding it for years can generate far better returns than trying to chase short-term gains. Risk management is not just about diversification. It also involves knowing your personal comfort level. Only invest money you can afford to leave in the market for the long term, without needing it for immediate expenses. Emotional discipline is crucial. Market corrections and volatility are normal. The key is to stick to your plan, buy quality companies consistently, and avoid reacting to daily market noise. Over time, the combination of capital appreciation, dividends, and compounding will turn even small investments into significant wealth. Beginners should focus on creating a repeatable system. Choose strong companies, check fundamentals, buy at reasonable valuations, diversify, reinvest profits, and stay invested long-term. By following this approach, you are not gambling. You are building ownership in real businesses and letting time work for you. In the next part, we will go deeper into practical tools and resources that beginners can use to research US stocks, track performance, and automate investments even from outside the United States. The next step for beginners is learning how to research and track US stocks effectively even from outside the United States. Start by using reliable financial websites and apps that provide company profiles, earnings reports, key metrics, and historical stock performance. Focus on understanding revenue trends, profit margins, debt levels, and cash flow rather than short-term price movements. Set up a watch list of companies you are interested in and monitor their quarterly earnings and news updates. Automation is your friend. Consider using brokerage accounts that allow recurring investments or fractional share buying so that you can invest consistently without needing to time the market. Keep track of your portfolio performance over time, but avoid checking it every day to prevent emotional reactions. Learn the basics of diversification by investing across different sectors such as technology, healthcare, consumer goods, and energy to reduce risk. Understand that temporary market drops are normal and should not trigger panic selling. Instead, see them as opportunities to add quality stocks at better prices. Reinvest any dividends automatically to benefit from compounding. As you gain experience, gradually refine your system by analyzing which types of companies and sectors perform well over time and which ones are more volatile or risky. Remember, successful investing is not about predicting the next hot stock or timing the market perfectly. It is about following a disciplined process consistently, managing risk, and letting time work in your favor. By building this system, even beginners can grow wealth steadily, avoid common mistakes, and gain confidence in investing in US stocks over the long term. In the next part, we will cover how to evaluate risk properly, how to decide how much to invest in each stock, and how to stay disciplined during market downturns to ensure long-term success.